Welcome to Framework Fortune. I'm your host Ben. If you're new to the stock market and day trading and you want to learn more, be sure to hit that subscribe button and the notification bell. So in this video, I'm going to go over several strategies that I use for day trading and swing trading that can be very effective if you use them correctly. Now we're going to jump into Thinkorswim and go over these examples. Be sure to stick around for the entire video so you don't miss a thing. Let's go. So the first strategy I'm going to talk about is dip buying. And dip buying is basically buying a stock after it's been oversold pretty quickly at a strong support level, looking for a bounce in price. Now my example today is MFA. This was a stock that a lot of people made some money on this past week. And you can see on this chart here, this is a daily chart. So each candle represents one day. And this is over a whole year. And you can see the past year that MFA has rode around $8 until this whole coronavirus and recession shenanigans that is happening now. So you can see the stock sold quite a bit from $8 down to 32 cents. That is a very big sell-off. And this stock is actually a dividend stock. You can see down here on Thinkorswim these little money signs that say 20 cents. They pay a quarterly dividend of 20 cents, so annually that's 80 cents a share. So buying at these at 30 cents is a steal. It's a great deal. And you can see as soon as it hit that low of 32 cents, 2 days after, it was all the way back up to $2.90. And this is the point of dip buying. The chart we're looking at now on MFA is an intraday chart, and this is used for day trading. This is 5-minute candles and only one day. So we're going to take a look at it here. And you can see you have a drop here in this one day on MFA all the way down to $1.55. And then it had a nice bounce back up here to $1.96. So that's about a 40-cent move in the span of about maybe an hour. That's a pretty good day trading move. If you can make 40 cents on 1,000 shares, that's $400. That's a good dip buying opportunity. Now, how do you decide where to buy in? How do you decide this is the point? You have to find strong support. So we're going to go back on this chart and look. And you can see right here, past chart resistance, the stock came down to about that same price, $1.62 and $1.50 area, and it bounced right there. So one more chance, you could probably get another bounce. And you can actually draw a line right here straight across this. And you can see there's some pretty strong support at this $1.70 area. It cracked below $1.70, but you can see one candle here bounced off of this support line before it had this final crash. And then it started coming back up and it hit right here, that same 170 area, came back down. Hit again, this time it broke. Old support becomes new resistance. Old resistance becomes new support. Okay, very simple. So now it's above that, it comes back down to that 170, that's 170 mark, which was old resistance here, so it turns into new support here. So old resistance, new support. And you get a bounce here. And then one more time, you get a bounce here. Now, 30 cents is extremely low. And there's really no telling that if this stock was going to get that low from where it was at $8. It's broken through a lot of support, so you couldn't really tell. But somebody bought this at that 29-30 cent area. Why is that? Because if you look here, this is a massive sell-off. Right here from $2.90 straight down pretty much to 29 cents. That is way too much selling. It's way too oversold at that point. Too many people have sold it and nobody has bought it. If a stock comes down that fast, most likely it's going to come back up. Now, it might not come back up to this extent, but it will still come back up somewhat. There's always bounces on stocks. And if you look even closer on this intraday chart, you can look at the candles at different areas where it had bounces. This first initial candle, it came all the way down here to 181, came back up to 226, then it sold off again, and then right here at that same mark, this candle right here, 181, it bounced again. So you could have got a dip buy right there from 181, and sold at $2. $2 is natural support and resistance, so $2 will hold up as natural support and resistance. So when it hit $2, it came back down and sold off some more. So when you're day trading, you're just looking for very quick dip buying opportunities. So you had a dip buying opportunity here, then it drops down. And when you saw that support and resistance line that ran straight across, like I said, you could have got in there. You have another sell off right here. The stock comes down to about 175. Every 25 cents is natural support and resistance. It bounced off 175, and now it's going sideways right above 175. So that 175 area is holding up as support. So now when the stock has held up for this long, you can see this is about an hour and a half that it held that 175 support. Traders and investors are going to say, okay, that's some pretty strong support. This might be a buying opportunity. So you buy right there, and you get a nice little move back up to almost $2. It went to $1.94. While you're not going to get rich off of one dip buy, multiple successful dip buys over time are going to add up. So if you make one dip buy trade a day and you average around $50 of profit over a week, that's $250. So over a month, you're looking at maybe about $1,000 you've gained off of the dip buying strategy. So that next month, because you have more funds to use, now you can start scaling up and maybe buying a little bit bigger position sizes on the dip buy. So instead of $50 a day, now you're making $100 a day. So you just take the dip buying strategy and keep scaling up your position sizes. As long as it's successful, then you will also be making more money. If you're not doing the dip buying strategy right and you're losing, then you don't want to keep doing it. You want to figure out what you're doing wrong and adjust and get that strategy right. Because stocks go up and they go down every single day, every single minute. So there's always dip buying opportunities if you can spot them. So the next strategy we're going to talk about is scalping. And scalping is basically buying on momentum and selling into that same momentum very quickly. So you're buying as soon as the stock is starting to move in the upward direction and selling out of it while it's still moving in the upward direction. So you're not going for big 50 cent to dollar gains with scalping. You're going for small gains, 5 cents to 25 cents. But you are buying bigger position sizes. So you normally might buy 500 shares of a stock, but for a scalp, you'd probably buy 2,000 shares of the stock. So that way, those little price increments will make more money. So if you've got 2,000 shares and you buy at the 10-cent break here on TOPS, and it runs up to 15 really quick, and you sell, you made 5 cents of profit on 2,000 shares. That's $100 of profit. And you're not in the stock for very long, so you have a little less risk, because as soon as you go up in some profit, you're basically just jumping out, just quick scalps. And you can do the same thing with dip buying and continually make these successful scalps on a small level, maybe $50 to $100 a day, and then start scaling up when your account gets bigger to where you're making $200 or $300 a day, but you're still using this same strategy. And what you're looking for is stocks with momentum to the upside. So TOPS started running, like I said, break at 10 cents. You get in there, you get a nice quick little scalp. Okay, you get out, it drops back down. You have an opportunity right there, maybe to dip buy if you want. But when it starts moving back up, you could jump right back in there at 15 cents, ride it up to 20 cents real quick. So that's another 5 cents right there that you could have scalped. And you can do this as long as the stock's running. So you're not waiting around on a dip buy right here looking for a bigger move like this. You're just buying right here, quick little rip, quick little grip, quick little rip. Now this one was quite a bit bigger of a rip, but still, you probably would have got out quick again with a scalp. If you're on a margin account or you have a bigger account, you can do these scalps multiple times a day, and those gains will add up. But there's another opportunity right here to do a scalp. Stock comes down, hits this VWAP line, bounces off. You can see it starting to bounce. Buy in quick there, sell quick here. So while you're using bigger share sizes to scalp, because you're in the stock a lot less longer and you're buying into momentum and selling into momentum, you're not risking as much as you would for, say, a momentum breakout trade. You're in and out of the stock quick, you're getting your gains, and with scalping, you want to use tight stop losses. So, for example, because you're using those bigger share sizes, you don't want to be risking too much on these scalps. So you buy in at 10 cents, you probably want your stop loss at like 9 or 8 cents. So if it does start coming back down some, you're instantly out and you take a very, very small loss. When scalping, you have to keep your losses extremely small because your wins are small. So you need to keep that risk management very, very tight so your small profits will add up and those small losses won't affect your profits too much. So the final strategy I'm going to talk about is momentum breakout strategy. And this is where you're looking for a stock that has some type of catalyst and a whole lot of volume that is going to push through a resistance level and have a breakout. And we're going to look at EKSO, which went on a pretty nice run yesterday as an example. And if you're looking at this chart, you want to find where would that resistance breakout be. So if you look at the whole chart over the past year, there's not really anything above here that would be resistance. The closest you have is this 254, but it's higher than that. So all you have to go off of is natural support and resistance. But you look at this candle right there, this candle hit right there. So $3, that candle hit there, that's past chart resistance, and $3 is also natural resistance. So we know that's a resistance line. The stock kind of just went sideways and started coming up, but right here towards the end of the day, 3 different candles hit that $3 mark. So as a momentum breakout trader, you're looking for this to break over $3 to buy. So right here on this candle, when it breaks $3, that's when you enter the stock, and then it goes on a nice run, because after $3, there's no other resistance, except there's a little bit here at 340, but 340, 350, it's not going to be a whole lot of resistance because $3 was the main resistance area. So you get a breakout, and of course it ran almost all the way to $5. So momentum breakout traders are different than dip buying or scalp traders, because momentum breakout traders are looking for a lot bigger wins. These momentum breakout trades can be a little bit more risky though, because sometimes they don't break out right away and you might take a loss because it hits your stop loss. Sometimes they look like they're going to break out, then they'll go sideways a little bit, dip down, hit a stop loss, then you're out of it, and then they start ripping. So they can be very risky, and they don't always work. Like this could have easily hit $3 and then just sold off at the end of the day. So breakout traders are trying to get those bigger moves. If you bought 1,000 shares of this stock at $3 and it runs all the way up to $4.50, which it ran to $4.84, but I wouldn't have held that long. I definitely would have sold by $4.50. That's $1.50 a share, so times 1,000, that's $1,500 in profit. But you still want to keep your stop losses tight, because you don't want your losses to outweigh your wins. You need your wins to outweigh the losses if you're going to make profit. With breakout momentum trading, you want to have a little wiggle room so you don't get stopped out automatically before the big rip. Now, most momentum breakout trades need several different attributes to go on these type of big breakout runs. And they need a lot of volume, they need a catalyst like a good press release or some type of good PR, and they need a good chart pattern. If there's a whole lot of resistance ahead of a stock price, it's going to be really hard for it to have a big breakout, because it's going to have to knock down every one of those walls. So this has been an overview of some of the strategies that I use and that other traders use. Of course, they're a little bit more in depth than what I've talked about in this video. If you want to learn more, like I said, go ahead and hit the subscribe button. You can also ask questions. You can find me on Instagram at framework_fortune. We also have a Facebook group. You can go to groups and search for the Framework Fortune Day Trading Group and ask questions in there. There's plenty of competent traders in there that can answer your questions as well. I'm your host, Ben. You've been watching Framework Fortune.